The 1980s. Japan was booming, money flowed freely, interest rates were low. This created an opportunity. Investors could borrow yen cheaply. They then invested this money elsewhere. They sought higher returns in other countries. This was the birth of the yen carry trade. This strategy was simple. Borrow low in Japan, invest high overseas. The difference in interest rates was the profit. It seemed like easy money. Many investors flocked to take advantage. The yen carry trade became a popular strategy. Why were Japanese interest rates so low? Japan's economy was facing deflation. This is the opposite of inflation. Prices were falling. This discouraged spending and investment. To stimulate the economy, the Bank of Japan kept interest rates low. These low rates made borrowing cheap. Investors saw an opportunity. They could borrow yen at a low cost. Then they invested in assets with higher returns. These assets were often in countries with higher interest rates. This difference in rates was the key to the trade's profitability.
The yen carry trade wasn't just for big banks and corporations. Ordinary Japanese people participated too. Mrs. Watanabe became a symbol of this trend. She represents the Japanese housewife. Many were actively managing their household savings. They were drawn to the potential profits of forex trading. These women were tech-savvy. They embraced online trading platforms. They became active players in the currency market. Their participation added to the flow of money into the yen carry trade. Mrs. Watanabe became synonymous with the everyday investor looking for better returns.
How does the yen carry trade generate profits? Let's delve into the mechanics of this intriguing financial strategy. Imagine borrowing 100,000 yen at a 1% interest rate. This low borrowing cost is the first step in the yen carry trade. You then convert this borrowed yen into US dollars. The exchange rate at this point is crucial as it determines how many dollars you get for your yen. Next, you invest these US dollars in a US bond yielding 5%. This higher interest rate is what makes the carry trade potentially profitable. The difference between the borrowing cost in yen and the investment return in dollars is your profit. Essentially, you are earning the spread between the low Japanese interest rate and the higher US interest rate. However, there's a catch. Exchange rates fluctuate, and this can significantly impact your profits. If the yen strengthens against the dollar, your profits erode. In this scenario, your US dollar investment is now worth fewer yen when you convert it back. This means that even though you earned interest on the US bond, the exchange rate movement can reduce your overall profit. This can wipe out your gains and even lead to losses. The volatility of currency markets adds a layer of risk that can be difficult to manage. This currency risk is the biggest danger of the yen carry trade. Traders must constantly monitor exchange rates and market conditions to mitigate these risks. Understanding and managing these risks is crucial for anyone engaging in the yen carry trade. Section 5. A historical perspective from boom to bust. The yen carry trade thrived for years. Low Japanese interest rates persisted. Global investors enjoyed significant returns, but the music stopped in 2007 to 2008. The global financial crisis hit. Investors panicked. They rushed to unwind their positions. They sold their foreign assets. They bought back yen to repay their loans. This massive unwinding caused the yen to surge. The carry trade backfired. Many investors suffered significant losses. Section 6. The yen carry trade today, a changing landscape. The yen carry trade, a strategy where investors borrow yen at low interest rates to invest in higher yielding assets, has been a significant player in the global financial markets for decades. The yen carry trade didn't disappear after 2008, it evolved. The financial crisis of 2008 was a turning point, causing massive disruptions in the global economy. However, the strategy adapted to the new financial environment. It's still a factor in the currency market. Traders continue to leverage the low borrowing costs in Japan to seek higher returns elsewhere, making it a persistent element in forex trading. But the landscape has changed. The global financial environment is constantly evolving, influenced by various economic policies and market dynamics. Japan's interest rates remained low for years after the crisis. The Bank of Japan, under the leadership of Haruhiko Kuroda, maintained a policy of low interest rates to stimulate economic growth. But recently, things have started to shift. The global economic landscape is changing, and Japan is not immune to these shifts. The Bank of Japan is now facing pressure. Global inflation is rising. As inflation rates climb worldwide, the Bank of Japan is under increasing scrutiny to adjust its monetary policies. There are calls for Japan to raise interest rates. Economists and financial analysts are debating the potential impacts of such a move on both the domestic and global markets. This would make the yen carry trade less attractive. Higher interest rates in Japan would reduce the appeal of borrowing yen for investment purposes. Higher borrowing costs erode potential profits. As borrowing costs rise, the margins for profit in the yen carry trade diminish, leading to increased market volatility. The future of this strategy depends on the Bank of Japan's next move. The decisions made by the Bank of Japan in the coming months will be crucial in determining the viability of the yen carry trade moving forward. Investors and traders around the world are watching closely, anticipating the potential shifts in the financial landscape.
Section 7. The Global Ripple Effect, Yen Appreciation and its Implications. The yen's value impacts the global economy. When the yen appreciates, it strengthens against other currencies. This affects Japanese exports. They become more expensive for buyers using other currencies. This can hurt Japanese companies that sell products overseas. A stronger yen also impacts global investment flows. Japanese investors may pull back from foreign investments. Their yen now buys less of other currencies. This can reduce investment in those countries. The yen's movements have far-reaching consequences. It's a key player in the global financial system.
Section 8. India's stock market, navigating the global currents. The Indian stock market is a dynamic entity influenced by a myriad of factors, both domestic and international. Understanding these influences is crucial for investors and policymakers alike. How does the yen carry trade affect India? The yen carry trade, a popular strategy among global investors, involves borrowing in yen at low interest rates and investing in higher-yielding assets elsewhere. This strategy can have significant ripple effects across global markets, including India. It's part of a complex web of global finance. The interconnectedness of global financial markets means that actions taken in one part of the world can have far-reaching consequences. The yen carry trade is a prime example of this interconnectedness. When the yen strengthens, it can impact other emerging markets. A stronger yen makes it more expensive to repay yen-denominated loans, leading investors to unwind their carry trades. This can result in capital outflows from emerging markets. Investors might pull money from these markets. The sudden withdrawal of capital can lead to increased volatility and downward pressure on asset prices in these markets. They may seek safer havens. In times of uncertainty, investors often flock to safe haven assets such as gold or government bonds, further exacerbating the outflow from riskier markets. This can lead to a decline in stock prices in countries like India. The Indian stock market, being an emerging market, is particularly susceptible to these shifts in global investor sentiment. However, the relationship is not always straightforward. While the yen carry trade is a significant factor, it is not the only one influencing the Indian stock market. Other factors influence India's stock market. These include global economic conditions, geopolitical events, and changes in commodity prices, among others. Domestic economic conditions, government policies, and investor sentiment all play a role. India's economic growth, fiscal and monetary policies, and the overall confidence of investors in the market are crucial determinants of market performance. The yen's impact should be seen in the context of these other forces. It is the interplay of these various factors that ultimately shapes the trajectory of the Indian stock market, making it a complex and fascinating area of study.
Section 9. The Perils of Prediction, a word of caution. Predicting the stock market is notoriously difficult. Many experts have tried. Few have succeeded consistently. The market is influenced by countless factors. Some are predictable, others are not. The yen carry trade is just one piece of the puzzle. Investors should be wary of anyone claiming to have all the answers. Market movements are often driven by emotions, fear and greed. This makes it difficult to predict with certainty. Prudence and diversification are key. Don't put all your eggs in one basket. Section 10. Echoes of Bubbles Past, a lesson from Warren Buffett. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This wisdom applies to the yen carry trade. When it was popular, many investors piled in. They were driven by greed. This exuberance contributed to the trade's eventual unwinding. Today, caution is warranted. The yen's future direction is uncertain. The global economy is facing numerous challenges. Investors should heed Buffett's advice. Don't get caught up in the hype. Make rational decisions based on careful analysis and risk management. Section 11. Conclusion. The yen carry trade's enduring legacy. The yen carry trade has been a feature of global finance for decades. It highlights the interconnectedness of the global economy. It demonstrates the potential profits and risks of currency speculation. It shows how a single country's monetary policy can have global ramifications. As we move forward, the yen carry trade will continue to evolve. Its impact on global markets will depend on a multitude of factors. Understanding this strategy is crucial for navigating the complexities of the global financial system.